New looks at inflation, retail sales, and jobless claims this week, leading to a bunch of new predictions about what the Fed is going to do next. Joining us now for his take, former Fed Vice Chair Richard Clarida. He's now Global Economic Advisor at PIMCO. Richard, thanks for joining us.
Yeah.
All right. So let's talk about next week. What do you expect to hear from Fed Chair Powell about the direction of monetary policy and interest rates?
Well, Steve, thanks for having me on. I think we have a preview because I do think the chair will be inclined to stick pretty close to the press conference after the July 31st meeting. He also was at Centra and on Capitol Hill. So I think he will basically stick to the message of acknowledging substantial progress in reducing inflation, acknowledge that now that they're close to the inflation goal, that they're now definitely a dual mandate central bank. You know, we heard from Austin Goolsbee recently about they're really now focused, in my term, on sticking that soft landing and making sure that they maintain, if they can, maximum employment. I would not expect him to give any broad hint, about 25 versus 50. I do think that in September will be data dependent on what we get on the employment report. So maybe he'll use this as an opportunity to give a little bit of a retrospective on the last 2 years. Of course, 2 years of Jackson Hole, an important speech, the whatever it takes speech. But that's what I expect.
Richard, I want to know how you reacted, or how you might have reacted as a policymaker, which you very recently were, to the events of the last couple weeks. We were going to hell in a handbasket for a couple days there when the jobs report came out, and then the market sold off on Monday. And we had that a little bit higher than expected jobless claims. Then jobless claims came back in. They didn't shoot through the roof. Then we had strong retail sales. How do you incorporate all this? And are you surprised at how the market and even some of your economist friends reacted to all this?
Well, I will say it. Indeed, I was actually traveling in Latin America when a lot of those events were happening, and I made a note to myself that if I were, back as Fed VC, the way I'd be looking at it in real time is, I wouldn't be inclined to adjust my view on monetary policy because carry trades unwound and equities had a correction from very lofty levels. And so I'm glad subsequent events have sort of put that into context. I think we have a lot of information about the economy. Underlying growth is around trend. Labor market has come into better balance. Jay Powell says they don't want to be data point dependent. And I think that makes sense. But I would emphasize that I do think that there is special importance in what we hear about the labor market. If the next print that we get early September looks like the average of the last several, I would be inclined to think that they go 25 and signal more in the way. If it's a disastrous report, negative payrolls and big resident unemployment, right, then we'll go 50. So I do think it's data dependent for that first move.
Richard, you just underscored a point that I think I try to make a lot, which is that the market thinks the Fed thinks about it more than it actually does. But I want to move on to another point here, which is where do you think, how much can the Fed do here? And would it still be restrictive? It's kind of asking you, where do you think neutral is? But is the market crazy in thinking about 100 through the end of this year and 200 basis points of cuts a year from now?
I don't think that's crazy. I start with the dots. They're imperfect, but the dots sort of indicate one scenario, which is a very soft landing with inflation gradually returning to 2 from above. And then the funds rate sort of follows that down over the next 2.5 years. That path could make sense, but also you could make a case, as Goolsbee and others have, that it would be rather restrictive to keep the funds rate where it is when you're at 2.1 or 2.2 on inflation. So I do think we could get more rapid reductions, down the road than are in the dots. But I think that's sort of a reasonable starting baseline.
What is the argument against 50 basis points in September?
Well, there is precedent for that. The Maestro Greenspan, had a cycle in 2000 when the first move was 50 and actually ahead of a meeting. So it can happen. There is a risk. And, during my time as vice chair, we saw this firsthand. We had an unscheduled meeting. We preferred that term to emergency. We had an unscheduled meeting in March, and we adjusted rates 50. And the market reaction near term was, oh my gosh, this is terrible.
But that was an emergency meeting. This is a scheduled meeting.
Yeah. Well, that's true. And again, they could, I mean, exactly right. They could tee up 50, have plenty of chances for communication between now and then. And I think there is data that we could get that for which that could be the move. My own sense is, the market, I think, pretty well understands the Fed reaction function. They didn't go at the July meeting, but markets began to price in cuts. And so my inclination would still be to begin with 25, but, ultimately 50 could be justified.
Richard, I have this idea of thinking about it. I don't know if it's too much of a metaphor for actual monetary policy, but you might want to maneuver yourself into a position to be able to provide stimulus to the economy if you need it.
Yeah.
If you did 100 now, you're still not going to be providing stimulus. According to your own calculations, I don't mean yours, I mean those of the Fed.
Sure, yeah.
You're still holding back the economy. What do you think of that idea, which kind of supports Melissa's idea? Doing a 50, get to the point where you can provide help quickly and then make a decision about whether or not to provide it.
Well, yes, and in fact, it was interesting at the July press conference. I'm not sure if it was you, Steve. Someone asked the chair the 50 versus 25 question. My recollection, paraphrasing, is he said, we're not thinking about that. Here's what I'd say. I would say on that. I do think there is, although it may be diminishing in importance, I do think there's some path dependence here in the following sense. The last 3 years, and I was a charter member of Team Transitory, the last 3 years, have not been kind to that initial call. All's well that ends well, perhaps. But I do think the fact that there has been an inflation overshoot for the last 3 years is a factor that's probably influencing at the margin both the timing of the first cut and the pace. And so I do think, at the margin that could be relevant for some members.